Question 7. So in this question, what are we going to discuss? This is from your part A, right? We are going to discuss about the dividend capacity. Mostly the dividend capacity. We are going to talk about dividends. So today's question is on dividend capacity. Let's go through the requirements first, right? So first, part A, discuss Limni company's current dividend, financing and risk management policies, and suggest how the decision to return the funds back to the shareholders affect this policy. So this company, they are going to return. They have made a decision that they have to return the funds back to the shareholders. So now you have to tell how this will impact on the dividend financing and risk management policies of Limni companies. So here we have to talk about the dividend, the financing, the risk management policies, and also how the decision will affect. So it's for 8 marks, 2 marks each. Next, we have evaluate the dividend policies of each of the 3 companies. You have been given 3 companies and their dividend policies. You need to evaluate now, right? Why you have to evaluate the dividend policies? Because you have to invest in one of these 3 companies. And you have to discuss which company Limni will choose. So dividend policies of the 3 companies and discuss which company will be selected. Next, we have calculate and briefly comment on. So we have to calculate, we have to comment also. How much the dividend, here we have to do calculation, okay? How much dividends from overseas companies needs to be increased by to increase Limni company's dividend capacity by 10%. So in the case study, we saw that dividend capacity has to be increased by 10%, right? So for to increase that dividend capacity by 10%, how much dividends from overseas companies has needs to be increased? That needs to be worked out, right? Next we have, and it's for 3 marks, right? Discuss the benefits to Limni company shareholders of receiving repayments through a share buyback scheme as opposed to dividend scheme described above. So you have one dividend scheme, the other one is share buyback. Now you have to tell the benefits of share buyback. Why share buyback? Why not dividend scheme? To whom? Remember this, to whom you are saying the shareholders. You're not talking from the company's point of view, you are talking to the shareholder. And it's for 3 marks. First, we'll go through the case study. It's a quite a lengthy case study, right? So first, Limni Company is a large company manufacturing handheld electronic devices such as mobile phones and tablet computers. The company has been growing rapidly over the last few years, but it also has high research and development expenditure. It is involved in a number of projects worldwide, developing new and innovative products and systems in a rapidly changing industry. This is very important. Which industry is that company is? Because the type of industry or company is at will depend, okay, okay, how your risk management policies will be, how your financing policies will be, how your dividend policies will be, how your investment policies will be. All the kind of decisions that a company makes, how they are going to finance, how they are going to do a dividend policy, depends on the type of industry they are at. So this company, Limni company, is at what industry? Rapidly changing industry. That means it's highly risky industry. It's not an stable industry. Due to the nature of the industry, this significant growth in earnings have never been stable, as you see. You're right. So one of the feature of a rapidly changing industry is that earnings are not stable, but has depended largely on the success of new innovations and competitive actions. However, in the last 2 years, it seems that the rapid growth of period of growth is slowing with fewer products coming to the market compared to previous year. Okay. Limni company has never paid dividends and has financed projects through internally generated funds and with occasional right issues of new share capital. Mark this, how they are financing their projects. Never paid dividends. Financed how? Through internally generated funds, and then they went to right issue of new share. First internally generated and occasionally right issue share capital. Okay, it currently has insignificant level of debt. Please mark this, all you need when you are going to talk about the dividend policy, when you are going to talk about financing policies, when you are going to talk about risk management policies. You need this piece of information. So it has insignificant level of debt. That means it does not have much debt. Very minor. The retained cash reserves have recently grown because of a drop in the level of investment in your project. Of course, when you don't invest so much in the new projects, your cash will be retained, so that reserves will increase. And when you have to invest in your new projects, your cash reserves will be low because you have to, first thing you are going to touch is from your cash reserves only when you have to invest. And when you don't have enough, then you go for external finance. That's how normally it works. So company has an active treasury division which invests spare funds in traded equities, bonds, and other financial instruments and releases the funds when required for new projects. The division also manages cash flow risk using money and derivative markets. Treasury division is currently considering investing in three companies with the following after tax and dividend history. So you are given three companies: company Theta, company Omega, company Kappa. You are given profit after tax and dividends for the 5 years. Okay, all the three companies' share capital has remained largely unchanged since 2003. Recently, Limni Company's board of director, okay, came under pressure from the company's largest shareholders to start returning some of the funds currently retained by the company back to the shareholders. The BOD thinks that the shareholders have a strong case to ask for the repayments. However, it is unsure whether to pay a special one-off large dividend from its dividend capacity and retained funds, followed by small annual dividend payments, or to undertake a periodic share buyback scheme for over the next few years. So now, what's happening here is the board of directors, they are confused whether to go for a share buyback, whether to pay one large dividend, or whether to pay small annual dividend payments. They are confused, right? Whether it's dividend or whether it's a share buyback. So there are two scenarios here. It's not three. One of large dividend followed from its dividend capacity, followed by a small annual dividend payment. So this one, it's one. First you will like one of large dividend and small annual dividend payments. It's one scenario. The other one is share buyback. So out of these two, which one? They're confused. Limni company is due to prepare a statement of profit or loss shortly and estimate that the annual sales revenue will be 600 million. So sales will be 600 million, on which its profit before tax is expected to be 23% of sales revenue. So profit before tax is 23% of sales revenue. It charges depreciation of 25% on straight line basis on its non-current assets of 200 million. So depreciation is 25% on this, right? It estimates the 67 million investment in current and non-current assets was spent during the year. So 67 million investment in current and non-current. It is due to receive 15 million in dividends from its subsidiaries companies on which annual tax of 20% on average has been paid. So they 20% tax has been paid on this 15 million dividends which has been received. Limni company pays itself annual tax at 26%. And the tax authorities where Limni company is based charge tax on dividend remittance made by overseas subsidiary companies, but give full credit on tax already paid on those remittances. So how many percentage of tax did you pay on the remittances? Only 20%, but the tax you have to pay is 26%. That means 6% you have to pay more, because 20% only you have paid out of that 26%. You have to pay 6% more because you are getting that tax credit. You don't have to pay 26% because already you paid 26%. Again, you are not paying 26%, you're only paying that difference 6%, right? Because of that tax credit. In order to fund the new policy of returning funds to shareholders, Limni Company's board of directors wants to increase the current estimated dividend capacity by 10%. So, how much that increase has to be? First, you have to find the current dividend capacity. Then only you can increase it by 10% to find the new dividend capacity by asking the overseas subsidiary companies for higher repatriations. How much you have to ask from the overseas subsidiary for the remittance? First, you have to find the current dividend capacity. Increase it by 10%. Then only you will know how much, right? So first we have to discuss about the dividend financing and risk management policies and how the returning of the return funds back to the shareholders will affect these three policies. Quickly go through the answer, right? First, they are starting with the dividend policy. Just see how they have given the heading: dividend policy, financing, and then risk management. You have to give these headings like this. You cannot put everything under one paragraph. So dividend policy, they are saying many high growth companies such as Limni. So Limni is a high growth company. Okay, retain cash instead of paying dividends, right? They have told that they retain cash instead of paying dividends. They don't pay dividends and use the cash to help fund the growth. Many such companies declare an intention not to pay dividends, and as such, the shareholders expect their wealth to increase through capital gain rather than dividend payment. Now let's go to the financing. It's a small part. Financing, if this is a very big part, we have two different separate paragraphs for that. So financing, they are saying whenever financing comes, you need to talk about packing order theory, capital structure theory, all the theories you know. So capital structure theory suggests that to take advantage of tax shield on interest payments, companies should have a capital structure which is a mixture of debt and equity. Pecking order theory, you see how they're linking pecking order theory. You have to know all this theory to link. The more theory, the more words you put here, the more marks you will secure for yourself. So pecking order theory, what is pecking order theory? Please know. It suggests that companies typically use internal generated funds before seeking to raise external finance debt. Initially debt, then equity. So pecking order theory says when you have for the finance, when you need money, first you will use your return earnings, second you will use your debt, and if debt is also not enough, third only you will go to your equity. So equity should be your last reserve you're touching. But here it is going the other way around. First it is return earnings, then you are going to equity rather than debt. So the two main factors in deterring companies from seeking external finance. These are the two main reasons why the company is not going for the debt. Okay. External finance are favoring one investor group at the expense of another, and the agency effect. So this is one factor, and the agency, this is the second factor. Agency effect of providing additional information to the market. See, when you go for a debt, you have to give additional information to the market of yourself. Otherwise, how will you get debt? But when it comes to equity, you don't have to give any such information to the outsider, right? Because it's within your company, you are using internal resources, you are using your equity, that's fine. But when you go for a debt, you need to provide additional information about your company to the bank, to the finance providers, right? And also when you're using equity, you can favor one investment group at the expense of another, but it is not in the debt. So these two things are reasons why they are not going for the external finance. Now we'll see. So Limni company is following the pecking order theory to the extent that it is using internally generated funds first. Yes, that is correct. But however, it is deviating from pecking order theory and looking to raise equity finance rather than debt, even though it is currently has insignificant level of debt. And it is therefore not making full use of the tax shield. So they are saying they have insignificant level of debt. Even after that, they are not using it, right? They are not making a full use of it. What happens? The tax shield, you will lose the tax shield. Remember, debt, you have to pay interest, and that interest attracts tax shield, but equity will not attract tax shield. So you're not taking the full advantage of that tax shield. So this may be explained by the fact that limited company operates in a high risk, rapidly changing industry. I told you to underline this. The reason is this. Everything, whatever the answer you put, you need to include it with the type of industry in any company, in any paper, in any question in AFM. Not only AFM, even in your other papers also, SBL, SBR, you need to link it with the industry, type of industry. So this rapidly is a high risk. So because of that, they are saying where business risk is already high, right? When you're having a high, rapidly changing industry, that industry has a high business risk. So it may not, so they may not want to take a high level of financial risk. If you're taking a debt, that means you're taking a, what are you taking? You're taking, adding on financial risk by using significant level of debt. So other issues such as potentially restrictive debt covenant may also be a factor in the financing decision. Yes, if you're having a potentially restrictive debt covenant, you will not go for debt finance. So that also will be a factor in how you decide your financing decision. Now let's go to the risk management. So managing the volatility of the cash flows. What is risk management all about? You're managing the volatility of cash flows. Enables a company to plan its investment strategy more accurately. Limni needs to ensure that it will have sufficient internally generated cash available when it is needed for planned investments. So more importantly, since Limni faces high level of business risk as discussed above, the company should look to manage the risks that are beyond the individual control of the company manager. Now let's see what is the effect. This is the fourth subheading you have to use. There were four questions which were asked in the single requirement. These are your sub requirements, right? So, effect on policies by returning funds to shareholders. Returning funds to the shareholders will affect each of these policies. How it will affect, let's see. So first you need to put this line, whether it will affect or not. First you need to put that line. That line will be your first line. You can say returning funds to shareholders will not affect the policies, or that also you can say. You're not wrong, but you have to justify your answer. Remember that. And always try to come up with the points where it's easy for you to justify, where you are getting more points towards. If you are getting more points where you say that yes it is affecting, then write those points. If you are getting more points where you are saying that it does not affect, write those points. It depends on whether you can justify it or not. It's not about which is correct, which is wrong. It's more about whether you can justify your answer. And if you can justify, it's anything is okay. Right? Any answer is okay, but provided you justify it correctly. So here they're saying effect. So we'll see how it affects. The shareholder client. Okay, the shareholder clientele could change, which may lead to share price fluctuations. Okay. However, since the change is being requested by shareholder, see this change is being requested by whom? By the shareholder. There is a good chance that this may not happen. Clearly, they are linking this to the case study. Because this is in this case is requested by shareholders, so there's a good chance that this may not happen. So the financing policy is likely to change since there will be less internally generated funds available. How? Because you're returning to the shareholders now. What will you have? What will be left in the company? That internally generated fund. From there, you will pay to the shareholder. You will not have anything left. So it will affect the financing policy. You have to look for the external debt now, right? So Limni may consider taking on additional debt finance, and therefore we'll have to look at the balance of business and financial risk. Yes, this could in turn change the risk policy, as interest rate risk will also have to be managed as well. Why interest rate risk? Because if you take more debt, see, because you are paying your now out of your internally generated funds, you are paying back to the shareholder, you will not be left with internally generated fund. For that you have to go for the debt. So your financing policy will change. Once your financing policies change because of that debt, you have to pay interest. So that interest also needs to be managed. So risk management policy also will change because of interest. So that there's a risk. So that interest rate risk now needs to be managed. So the risk management policy also changes. Now let's go to the part B. Part B, we are talking about the three companies we are comparing, evaluating which company they should choose. We are discussing on their dividend policy. So first is theta, then omega, then kappa. Theta. Before we talk about theta, let us go back to the question and see the theta. Right? Company theta. So just look at the pay, profit after tax and dividend. Right? Just see that the profit after tax is increasing, dividend is also increasing. But how much that increases? When you have to say that, you don't have to calculate year by year. You just calculate the 2003 and 2007, the latest and the earliest, and you can compare. Let's say now you want to compare. Okay, let's take out the payout ratio, dividend payout ratio. How will you calculate the dividend payout ratio? Dividend payout ratio is, okay, it will be your dividend divided by your profit after tax. That's how you get your dividend payout ratio. And we all know how to get that increase from one year to the next year. There's a dividend in the 2003, if you see for data, 18,200 divided by 45,500, you are getting 40%. Even for 2004 you will get 40. 5 also you will get 46, also you will get 47, also you will get 40. Try this on your own, you should get 40% for all the year. Therefore they are saying, where is theta? So here, company data has a fixed dividend payout ratio of 40%. As a result, the increase in dividend in recent years depends on the increase in the profit after tax in these years, rather than increasing at a steady rate, which is often preferred by shareholders. If profit after tax was to fall, now you see what happens. Tata may reduce its dividends. Exactly, because they have fixed a dividend payout ratio at 40%. So if profits fall, dividend will fall. Which could now, because that dividend will fall, what happens you see, which could send the wrong signals to the shareholders. Whenever dividend is falling, it's not a good signal. It's a wrong signal to the shareholders, and cause significant fluctuations in share price. So to avoid this, what you can do? Tata may keep a stable dividend in years of reduced profits, right? Because of that fixed dividend payout ratio. So now let's go to Omega. Omega, if you see, they have calculated some ratios. We'll see how they've calculated. First, we'll read what they have given under Omega. So company Omega has a policy of increasing dividends at approximately 5% per year, but earnings are only increasing at a rate of 3% per year. Okay. This means that the dividend payout ratio is increasing. It was 60% in 2003 and is 65% in 2007. That means the dividend payout ratio is not constant. It's not the same like how it was for Theta. We'll calculate the increase in dividend and increase in earning and also the dividend payout ratio for Omega. Let's do that. And if you see for the dividend payout ratio, they didn't calculate year on year on year on year. It's time consuming. It does not, right? You have to be short and to the point. You don't have so much of time. Whenever you're given for many years, 5 years, 6 years, 3 years, to just calculate the latest and the earliest to compare, right? So here they are taking 2003, that was the earliest, and 2007 is the most recent. So we'll do that like that, okay? But but when you're taking the growth and all, it's okay. You can take growth. So when you take the growth, I will just show how they have taken the growth for 2003 off for the dividend, right? Here, Omega is this one. So it will be 52 minus 230. 52, yes, sorry, 52. Minus 49,740 divide by 49,740. Likewise, for all the years you have to do, even for the profit after tax, you have to do like that only. Year on year, you have to take and see what is the increase. Sometimes you might get 2.9, sometimes you might get 3.1 or 3% like that, but approximately you can round up to 3%. So when you see that increase in profit after tax, it will be around 3% and dividend will be 5%. And profit after ratio, dividend payout ratio, if you see, just take 2003, that is 49,740 divided by 82,900, that will be 60%, and the latest year 2007, which is 6560 divided by 93,300, you will get 65% something, right? So that's what they have calculated here for Omega. Okay, now we'll see. Although this cannot continue in the long term, it suggests that there are less investment opportunities currently, and Omega is reducing its retention ratio. See, Omega is reducing its retention ratio. If you increase your payout ratio, means your retention ratio is decreasing. When does your retention ratio decreases? When you are not investing anywhere, right? Then there might be, maybe there are not much opportunities. That's why they are saying that, because you can see dividend payout ratio is increasing year on year. So there are less investment opportunities currently. Based on the dividend payout ratio, they are saying this, right? So this investment would be attractive to an investor looking for a high level of dividend income. Okay, so this type of investment, this Omega, which type of investor will invest in Omega? The one who are looking for high level of dividend income, because just see, your dividend is increasing at 5%, dividend payout ratio is increasing from 60 to 65, right? Now let's go to Kappa. Kappa, if you see, company Kappa has increased its payout ratio from 20% in 2003 to 27% in 2007. That also will calculate. First we'll go through the answer and then we'll calculate the figure, right? This is a fairly okay. So when you most of you might have this doubt, what ratios to calculate? How do we know, looking at a number, which ratios to calculate? For that also, whenever you are getting this type of questions with dividend policy, you have to calculate. Look at this few things. Let me write it down here. Okay, so let me write this few things which you need to look for. Okay, so first is dividend payout ratio. Okay, First thing, whenever dividend, something related to dividend, everything related to dividend you have to calculate. Second is your dividend growth in dividend. Second, growth in your earnings also you need to see. And you need to compare, by the way, right? You need to compare your dividend increasing growth in dividend versus increasing growth in earnings, right? So this few ratios you need to calculate. You might take on average, you might take year on year, but you need to take like here for kappa. Okay, so 20%, right? Pay ratio is 20% and 27%. This is a fairly low payout ratio, but it is growing. Yes, compared to other two companies where it was 40% to 60%, here it is just 20% and 27%. So this is a low payout ratio. Earnings are growing rapidly overall. We'll see. Okay, but not at a constant annual rate. 35% growth in 2004 and only 3% in 2005. Just check the difference. 35 to 3% it fell down. Okay. So overall dividend growth is at a rate, this is they're taking overall. Okay. Dividend growth is at a rate of 29% per year. And the annual dividend growth rate has been fairly constant. Yes. If you say annual also, it's around 29% only. So this policy seems consistent with the growing company. For which company this policy will work? For a growing company, which is now starting to pay more significant dividends and return more funds to shareholders. This investment would be attractive to investors seeking to a lower level of dividend and a higher level of capital growth. You can see the return payout ratio is less, right? So now we'll see the ratios. Okay, let's go to kappa. Kappa. Okay, so this is kappa. I take a column so that you can separate with the other two. Kappa, if you see from 78.3 to 16400, and just check the increases here, 82,900 to 930, not so much. Here also, if you see, it is 45,500 to 57,100. It is not so much. But when you see here, 78,300 to 162,400, that increase. So you can see it is increasing very rapidly, profit after tax in Kappa. And the dividends also you see it's increasing. And when you check out the increases in dividends, when you calculate it, you will get it around 29%, right? And earnings, you have to calculate for 2004 and 5. So 4, when you see, it will be like this something, minus 78,300 divide by 78,300, you will get around 35%. 78,300 to 105, that's a big jump. But for the next year, the change is very small. 180,900 minus 105,700 divide by 105,700. So it is just 3%. That increase reduced, right? Even though it's increasing rapidly. So that's what they have told here for omega. No, sorry, for kappa. Okay. Now we'll see which one they will choose. So finally, this paragraph is for the which one they should choose. So due to the uncertainty about whether Tata is the first company, and the company which had a fixed dividend payout ratio at 40%, they could could decrease its future dividend payments. Of course, there is uncertainty that they could decrease dividend payments. Why is that uncertainty is there that they could decrease? Because there is a 40% fixed dividend payout ratio. That means if your profit after tax falls down, your dividend also will fall down. And whether your profit after tax in future falls down or not, can you control it? Will you know it with certainty? You will never know it. So based on that, your dividend will pay out or fall down. So that's why that dividend could fall down there. So because that dividend could fall down there, Limni is likely to prefer to invest in either Omega or Kappa, because in both the company we saw dividend payout ratio is increasing. Now, the choice between these two depends on whether Limni would prefer higher dividend or higher capital growth. One company, Omega, is giving higher dividend, Kappa is giving higher capital growth. Which one out of this depends on the Limni company's choice? Which one is their preference? High dividend or higher capital growth rate? We are not given any details in the case study. So issues such as taxation position or length of time, you need to take care of the tax also, right? And the length of time that the funds would be invested for may influence this choice too. So whenever you come to AFM, right, you can never give, very rarely maybe, but there are areas, this I will no I will tell, these are the areas known as gray areas, right? Some areas it's like black and white, either it's black or either it's white, we know it, it's like yes or no, true or false, wrong or correct, we know. There's only one choice, you can go with it. But some area it is like you know this one or that one, depends. So this kind of answer is known as gray matter, gray area, right? You can never be 100% sure that you should go with this method because you are not given the full information. What will be impact on the tax, the length of the time, whether they prefer dividend or higher capital growth, that we don't know. So when you write your answer also, you have to write it in this terms, that the choice depends on whom? Limni company. You have to write this. You cannot tell that based on my opinion or I think or this one only I should, this one they should choose. You cannot say that. You cannot write this terms in AFM, right? You need to write this terms that this depends on Limni based on this factor. They need to take into account. Such kind of language should be, or should be there in your answer, right? They may influence this choice too. You have to write this because the choice between omega or kappa is not clear cut. You cannot say omega or kappa. So whenever you have this confusion, which one out of these two, you have to write this kind of sentences. Okay, now let's go to part C, current dividend capacity, that we have to work out. We have been told that profit before tax, see our revenue was 600 million from the case study, right? It was given, and we have been told that profit before tax is 23% on that revenue. So 23% of 600, right? Now here I want to tell you one thing, it is 138 if you take 23%, right? When you put in your calculator, you are not taking millions, right? You will be taking 600 only, 23% of on 600, so you will get 138. So that 138 is 138 million, right? 138, 23% of 600 will be 138 million. But here when you write, you are writing three zeros only, 138,000. Why? Because it is in zeros, you are dropping down the three zeros. If you want, if you are confused with the number of zeros, what zeros you have to use, you can write the full number as 138 million. That means you are putting the six zeros after 138. That also you can do, but then everything you have to work in millions, right? Because it could be quite confusing for you also, and time confusing for you to work putting all the zeros and all. This is better, right? You eliminate the three zeros, but make sure that you write the correct number of zeros after 138, that is the three zeros, right? Because 138 million means it will be like this, 138 0 0 0 0 0 0. Since this three zeros you are eliminating, you are just putting 138,000. So here you cannot go wrong if you are putting this on the top, that this are in millions. Then you have to count the number of zeros you are putting. Please don't make this mistake, because in your calculator you are not getting the number of zeros, you are just getting 138, 23% of 600. Okay, now tax is 26% on that. Okay, and then after we get the profit after tax, we have to just see, we have to add back the depreciation. Why? Because they have told clearly that they have charged depreciation. Charged depreciation means what? On your profit before tax, this figure, depreciation is already there, included there, they have deducted that depreciation. Okay, and then because depreciation is a non-cash item, you need to add it back. You need to add it back with profit after tax. For dividend capacity, we are finding cash balance. We need cash because from cash only we'll pay dividend, right? Not from the profit. So we have to calculate what? Cash only. So for that cash, we need to add back the depreciation. Less investment. Of course, investment from cash it will go. It needs to be deducted. They told investment in assets and non-current assets is 67 million. So that is 67,000. Overseas remittance, they told 15,000 they are going to receive. Additional tax, we have calculated the 6% because they have paid 20% on that overseas remittance, but Limni has to pay 26%, so the difference is 6% on 15 million on this remittance. Additional tax, right? Because you have paid less. So 900. And then this is your dividend capacity. On this dividend capacity, take 10% because you are supposed to increase the dividend capacity by 10%. That's why you are multiplying by 0.1, which is 10%. Now, remember this figure is tax is included here. After tax, that means they have deducted the tax already. Right? You need to include it before tax. You have to gross it up. Right? So gross up to allow for extra 6% tax. Extra 6% tax is not there. You need to gross it up. Right? So this is 0.91 because it will not be over 100. It will be 100 minus 6%. That's why it's 94%. So that's why the denominator will be 0.94. Right? So this is your dividend capacity. Now you have to see what is that percentage increase in dividend, remittance needed. So your remittance is 15,000. Now you have to increase it by how much? 11,087. So you're taking this as a percentage and you are getting 73.9%. That is the percentage increase. Right? Now, there's one problem with this. Okay. So dividend remittances would need to be increased by approximately 11.1. They have basically rounded up this 11,087. So rather than writing full amount, they are saying 11.1 million or 73.9%. Anything you can say. In order to increase the dividend capacity by 10%. Right? Limni needs to consider both whether this is possible for the subsidiaries and the motivation and the operational impact of doing so on the subsidiaries. Now let's go to part D. Right? Part D, you have to tell the benefit of the share buyback compared to the dividends, and it's for 3 marks. So you can see the answer is also very small. So the main benefit of the share buyback scheme to a shareholder is that to a shareholder, please, when you say the benefit, you need to know from whose point of view you're saying. This is not from the company's point of view, this is from the shareholder's point of view. So is that they can choose whether or not to sell their shares back to the company. This means that they can control the amount of cash they receive and in turn manage their own tax liability. With the dividend payment, especially with large special dividends, there may be a large tax liability as a result. So larger the dividend, larger the tax liability. Further benefits include the fact that as share capital is reduced, earnings per share figure is likely to increase. Right? And share price may increase too. EPS increase, share price may increase too. Additionally, share buybacks are often viewed positively by the market and the share price may increase. May increase, they are saying. So you have to use this words more, may, would, maybe, might, perhaps. Okay. And most of the time, if you see compared to dividend, share buybacks are seen more positive by the market. Right? And one thing which you need to understand here is we are done with it. We are done with this question. So before I end this video, they have told one thing that share capital. Okay. Share capital reduced means your EPS will fall down. How? Sorry, EPS will increase. How? Because what is the formula for EPS? Break down the formula. It is earnings divided by your share price. Earnings per share. Okay, earnings per share. So earnings per share. So if your share this down, if this falls down, I have told you before, lower your denominator. If your denominator keeps reducing, this number will keep increasing. You can check it. You can check this. 1 divided by 4 or 1 divided by 2, which one is greater? This is 25%, this is 50%, so this number is lower, right? So lower the number, higher the answer you will get. And now we have to go to the marking scheme of this. It's very important because there are some very important points which I cannot miss. So let's go to the top tips. Okay, part 8 is necessary to consider why they have 3 policies in place rather than just describing the existing policy. So you need to consider why they have these policies also, rather than just describing that existing policy. What are those policies? Risk management, financing policies, and dividend policies. In part B, you do not need to calculate dividend growth or payout ratios for every year. I told you, do not. To be able to pick up the marks, you can just consider the overall growth and look at the earliest and the most recent years to make sensible comments. Please don't waste your time doing that. It does not really matter which investment choice is recommended. See, it does not matter whether you choose kappa, whether you choose omega, whether you choose theta. What matters is as long as you can support your choice with a valid argument. Okay. Part C requires you to know how to calculate dividend capacity. This you should know how to calculate dividend capacity. Ensure that you learn the adjustments required to profit after tax. What was that adjustment? You are adding by the depreciation. That was the adjustment. You need to know these adjustments. If you did not already know this. Easy marks. What were the easy marks? The easy marks was evaluating the dividend policies of the 3 companies and in which company to invest. And also part D. What is the benefit of the share buyback? Okay, here they told it relates to the shareholders, not the companies. The benefit. Now let's go to the examiner's team comments. So the weaker responses to part A tended to be descriptive, often repeating the narrative of the question. Right? Many candidates fail to pick up the point that the nature of the growth of the industrial sector affects the risk management, financing, dividend policies of the company. Always it is like this. Part B. In part B, a sizable number of candidates were confused between stable dividends, data, and stable dividend policies, and thereby demonstrating a lack of sufficient knowledge and understanding. See, right? Some of them, they have calculated the current dividend capacity, okay, but few candidates then proceeded to calculate the increased dividend capacity. That means what happened was, they are trying to say is that candidates, they calculated the current dividend capacity. There itself they stopped. After that, they didn't show that increase in dividend capacity. This could happen out of 2 things. One, you don't know how to calculate the increased dividend capacity. Second could be, what is the second reason? You tell me. You didn't understand the requirement properly. Wrong interpretation of the requirements. When you read the requirements, maybe you didn't understand. Maybe you understood it as that you should calculate the dividend capacity, but you didn't understand that it was increased dividend capacity they are talking about. What is that percentage increase from existing to the new dividend capacity? Most of you must have not understood that. So it could be one of the 2 reasons. Either you didn't understand the requirement properly, either you don't know how to calculate that increase. Right? Part D. Main areas of weaknesses. Right? They only thought that one of these methods would provide instant cash to the shareholders, or that the requirement was not to compare the 2 methods with each other. So they just thought that it's one of them is to provide instant cash to the shareholders. That's it. They thought that they don't have to compare the 2 methods. What 2 methods? The share buyback and the dividend. That is what weakness. You have to compare. But to discuss the importance of returning cash to the shareholders, they focused more on that. What is the importance of returning cash to the shareholders rather than comparing the 2? Right? So this is how the marking scheme has been given. Explanation of dividend policy 1 to 2 marks. Explanation of financing policies 3 to 4 marks. You see why it is more? Mostly when you compare your dividend, finance, and risk management. Most of the marks is for the financing policies, right? Because there you have a lot to discuss about. We talked about pecking order theory, we talked about debt, external debt, we talked about how it will change the financial risk, all those things. It has more things to talk about. The more points you have under one policy, the more points you will get. It's not equal marks. Risk management is 1 to 2 again. And what is the effect of the dividend? 2 to 3. Part B, right? 2 marks per evaluation of each of the 3 companies. So you will get 6 marks for that. There were 3 companies and 2 marks you are getting for the evaluation. And first, which company you need to invest in. For discussion of that also you are getting 2 marks. Just for discussing that. Right? Part C. Calculation of initial dividend capacity and calculation of new repatriation amount. So for each we are getting marks, and also comment. Please don't forget about this. Most of you ignore this part. They just calculate and that's it. You need to comment and you're getting 1 to 2 marks for that. Finally, D, it's 3 marks. So it's 1 mark per relevant point. Right? So that's it for this. If you have liked this video, please put that likes and do subscribe to my channel and share this with your friends. Thank you for watching.